All right, everyone. Welcome to our final panel of the day, Funding Growth in Clean Tech. I'm so excited to introduce our moderator, another student moderator who also put this panel together, Adi. Adi is a first-year MBA here at Anderson. He's studying clean tech and venture capital. He's previously worked for PwC and Google in Singapore, which is a whole adventure you can ask him about later. Thank you very much, Adi.
All right. Solid. All right, cool. Thank you, Alex. I would like to take one moment to thank Alex. He's too modest and humble to admit this himself, but he is our lead organizer. So this event would not have happened if it weren't for him. So thank you, Alex. All right, with that, so 2022 was a record year for investment in clean tech companies. Globally, VCs deployed $70 billion in capital across over 3,300 funding rounds, which represents an 89% increase from 2021. Legislation like the IRA certainly promoted investments in areas like clean energy production, but the clean tech industry is still quite nascent and fragmented, with many different solutions being developed to tackle a multitude of issues from mobility and greenhouse gas emissions to waste management and the circular economy. The professionals on this panel have sought to alleviate the damage that we humans have inflicted on the environment and our own health by deploying capital and supporting financial transactions for some of the most innovative clean tech companies in the world. So with that, I'm going to hand it over to our panelists to introduce themselves real quick.
Good afternoon, everybody. My name is Tim Arnold, Anderson EMBA 21. Spent the first half of my career, I'd say, as an entrepreneur, a few exits along the way, and some part-time work here and there as an employee, and I found the entrepreneurship was definitely more for me. And that's at the time I came back to school, and after coming out of Anderson, started a venture capital firm, Steamwork Ventures, with two other partners, and we focus on health, wealth, and sustainability.
Cool. Thanks, Tim. Thanks, Adi. Great to be here, everybody. My name is Vaughn Blake. I'm a GP at Blue Bear Capital. We are early and growth stage investment firm really focused on the data layer of the energy transition. So we invest in a lot of software that optimizes, enables, protects, facilitates the energy transition in one capacity or another. We're investing out of our third fund now. Invest seed through Series B, so representing sort of the early stage component of the energy investing continuum. Prior to Blue Bear, I was an LP, really focused on emerging managers, so deploying capital on behalf of a single family office into emerging managers' investment strategies, everything from long short equity to macro. We did a crypto fund and obviously started out with a lot of venture. Prior to that, solo GP, really focused on investing at the intersection of deep tech and industrial and enterprise end markets. Prior to that, operator on the financial technology side with a couple of exits.
Good afternoon. My name is Michael Tsokur. I'm out of Boulder, Colorado. I run a firm called Boundless Capital Partners. We're an investment bank for lower mid-market energy transition. Prior to that, I was a fractional CFO and advisor to about 45 startups over the course of 5-6 years. And I love entrepreneurship. Blue Bear is a very good fund. Everyone should pitch them for sure. But thank you for letting me be here.
Hello, everyone. My name is Anil Tammineedi. See a lot of familiar faces. So I sat in your shoes 16, 17 years ago. I was a full-time MBA, Anderson MBA here, class of 08, and come back to teach different courses and also very involved with the Anderson Venture Impact Club here. I'm with a firm called Angeleno Group, which is a growth equity fund that's dedicated to just clean energy and climate solutions investing. We're one of the oldest firms in the space. We've been around since 2001, so going on 20 plus years with the same focus of all investing in clean energy and climate solutions. Invest in hardware, software, and service companies all across this clean energy sector. And happy to be here.
Awesome. Thank you all for joining. Really excited to have you all here today. So before we jump into the meat of the panel, obviously we do need to kind of address the elephant in the room, which is the SVB situation that has taken off over the past week. We're not going to spend too much time on this, but given that we have some truly brilliant investing and financial minds here, it would be great to kind of get your thoughts on this whole SVB First Republic situation and what implications you foresee resulting in the broader banking and investing industry in the coming months and weeks.
I would say for us, the first thing was to remove the emotion out of it, right? And start looking very tactically is what is the impact? What do our LPs need to hear? What do our entrepreneurs need to hear? And then start looking forward to different ways of financing because you no longer have access. So interest rates have gone up. That's one thing. But the second thing is the access to the debt capital. That puts a lot more pressure on the folks on this panel to come up with the cash as we're growing.
That's right.
Yeah, I mean, it was definitely unfortunate. And I think to Tim's point, perhaps an emotional response is kind of what drove the run in the first place. So, as managers, as fiduciaries, as LPs, and as board members, it's our sort of duty to make sure that everybody stays calm and that businesses can continue operating in one way or another. So, a lot of the last weekend rather for us was just making sure that payroll is going to be made. Making sure that LPs felt comfortable, for a period of time, putting a pause on capital calls for certain folks that we're about to send. But ultimately, I think the entrepreneurial ecosystem will be stronger at the end of all of this. So, looking forward to how things sort of repair themselves.
Yeah, I think that the venture capitalists that deploy a lot of capital and have $500 million under management aren't going to be really affected. I think it's the smaller funds, that seed stage funds, where they have LPs that come in basically because they're an asset class, right? As an LP, you continue to put money into every single fund. I think the LPs coming into the next funds are certainly have a bit more hesitation. So I perceive that it's going to be a little bit longer to get term sheets closed in the next couple of quarters, but I think it's going to be just fine in the long run.
I echo everything that's been said here. I think there's a lot of uncertainty. Uncertainty brings this emotional response and like trying to figure out, you retrench too much. So you have to, as investors and on the boards of our companies, we're trying to, very well said by Tim, that we're being more tactical about it. We had to step up to give comfort to our portfolio companies that we're here to wire money for matching payroll or other needs like that. But in the long run, things will, we see these blips come on frequently. We still don't know how big this could be and the impacts of it, so we're watching it carefully.
Awesome. Thank you for sharing those thoughts. So as I mentioned at the beginning of the panel, 2022 was a record year for clean tech funding. What would you say are some of the driving forces that, really drove that massive infusion of capital into clean tech companies in 2022?
I would say one of the things that really had a benefit was inflation. And the reason is, for us that we're smaller energy saving reductions, the value proposition starts to increase. You're no longer saving $1, saving $1.05, $1.10. So economically, there's more attention paid to these types of investments that we're making that can change the way you're heating and cooling your system, saving water, things of that nature, started becoming a little bit more attractive. It could be more expensive to invest and build, but that's a one-time fee versus a recurring positive there.
I think, capital flows are a pretty important component of that. And, never, I guess, in my investing career, have I seen as many climate funds pop up as did in 2021, 2022. And I think, correctly or through the lens of rationality, LPs understand that there's not only sort of necessity to solve this crisis using capital, but also some great returns to be had. So seeing all of those LP flows flow into a lot of new funds, you're going to see increased investment. So.
Yeah, I think over the last, I would say 3 or 4 years, the nomenclature climate tech or whatever you want to call it, naturally in venture capital, and I talk about private capital markets like PE, right? You have this first curve of a lot of capital flowing out because it's a hot trend, and then it normalizes because companies start failing. I think we're on the second wave of that in climate tech, and I think that a lot of investors are starting to understand that LPs want to put money into some of these themes, and I think that's driving a lot of investment for sure. And don't forget that innovation in its own is happening within that sector. That's now palpable. Before it was, I have a whiteboard idea, I just need a $50 million check for a pilot. That's never going to happen, right? So, we have programs like that. The government's great. The USDA supports a lot of infrastructure projects around energy transition, and I think a lot of those combined are driving a lot of capital forward.
I'll probably take a little bit longer view just to see why 22 was such a great year is because I've been doing this for 15 years. So I joined Angeleno Group right after graduating in 2008. So over 15 years of doing this, what I think it is a Hemingway quote. It said, how did it happen? It happened gradually and then suddenly. So there were a lot of factors that I think drove to this big activity last year, and I would probably put them into 4 categories. First one is technology. Solar, since I joined the firm in the last 15 years, solar has come down 90% in price. Wind has come down 70%. Energy storage, lithium-ion battery costs have come down 90%. When you bring down costs at that level of magnitude, it's once in a generation opportunity, right? So costs have come down. So I'd say technology innovation is the first factor. Second is consumer and corporate behavior. Consumers are millennials and sustainability. It's very obvious what's happening, all of us, and how educated we are. And then corporates, it was a staggering figure to when I read this, that 90% of public companies that contribute to the GDP have net zero pledges. 90% of the world's GDP. So the amount of money they have to move or products they have to consume and things they do operationally in this ecosystem, that's a huge factor. So they are customers. Right? Previously, energy meant, you're selling to utilities or oil and gas companies. But now energy, Google and Facebook and Stripe is one of the largest buyer of carbon credits and sustainability and products. So our power purchase agreements for data centers. So that's consumer and corporate behavior is number 2. Number 3 is government. So IRA is a huge factor, $370 billion. So I don't need to expand more on government being behind it. And the last and most important, I think, is talent. Like people in this room, number of entrepreneurs and students and even employees from Google wanting to have interest in coming over to energy and wanting to do this. I have 2 great interns here, McKinsey and Sydney, who are stellar interns that have interest, right? This is the next generation that we want to cultivate and entering this industry. So the future is great with that inflow of talent.
Yeah, that's awesome. And I'm glad you brought up the IRA. We'll definitely touch on that in a little bit. One thing I do want to focus on, though, is clean tech is obviously a very broad term that encompasses multiple verticals. What are some of the areas that your respective firms were most focused on in 2022? And how do you see that shifting at all, if at all, in 2023?
Yeah, for us, it's a lot of energy usage in existing buildings, smaller non-networking capital, intensive type of investments, things that can iterate how you're doing business, from today to tomorrow. A lot on water. We've had a lot of rains here, but that's still something that exists. Water conservation, I think, is something that we've kind of looked at, typically at a much larger scale and not broken it down as what can we do individually. And we're seeing more and more investments coming into toilets, bathrooms, drinking fountains, and the simple things because economically they make sense as an investment.
Yeah, our approach is, as I mentioned earlier, it's data centric. So by virtue of that approach, we're really focusing on assets that are operating and generating data that can be optimized, enabled, or protected. As a result, we've sort of rode the deployment curve down, to Anil's point earlier. As generation becomes less expensive and more accessible, there's usually more of that generation or more of that particular sort of piece of the transition value chain. So Fund 1 for us, we did a lot of wind and solar. Fund 2, we did a little bit more on the electric vehicle value chain, more in the battery value chain. I think that'll probably continue right now as we enter into the 3rd fund. Definitely looking at carbon management, the carbon landscape, more operationally, less on the speculative credit side. And then obviously some of the things that are on the new horizon, including energy intensive manufacturing, how to reduce, it's a massive carbon sink. And then looking deeper or farther on the horizon, trying to understand how we can really wrangle ourselves into the hydrogen supply chain in a way that's data centric. a little bit of, understanding how nuclear will sort of be debottlenecked on the regulatory side, but all data, all software, and asset light.
Yeah, 2022, we started from about 2 years ago. And initially our first deal we closed was actually a competitor of EVgo out in the Southeast. So we were some of the first people that approached lower mid-market companies and tried to figure out IRRs of chargers that have no guaranteed cash flow, right, to try to leverage those up. So a lot of that focus has been on EVs for us. We're about to launch a couple of deals around EV manufacturing. And of course, software has always been great. I come from, working with VC-backed companies, so we sold and raised money for companies that have to do with software and intelligence around energy management. But yeah, EVs for us is a big focus right now.
We as venture capitalists or fund managers, we're thinking of long term. So when there's trends, we want to make sure those trends carry on for the long term. And luckily, clean energy is a long term trend. So for the couple things that we did, we focused on last year and where we made investments. One is in electrification of the home. So we think obviously as more and more electric load is coming to the home, whether it's electric cars, solar panels, induction stoves inside the home, so the entire home is becoming electrical. So one of the biggest bottlenecks is your electrical panel. So you have to touch the electrical panel and upgrade that, and then the grid is not ready to charge. Take in so much load of EVs. If your entire blockchain, upgrades to EVs, there is not enough grid infrastructure to supply the power. So we invested in a company called Span that modernizes the electrical panel and allows you to manage the load at the panel level. And the second area where we made an investment, we're looking at companies all across the clean energy spectrum because, again, we believe it's long-term trends. But obviously, COVID showed the stresses in supply chains and manufacturing. So basically, onshoring of manufacturing was a big trend. So we invested in a company called Fictive that does manufacturing software so that Tesla or Apple engineers can use local manufacturing faster to quickly turn around products. So we think that's a long-term trend as well, because with the IRA and so on, there's going to be a lot more manufacturing, and that's a talent that the U.S. kind of hasn't cultivated in the last several years. So I think onshoring that would require more talent coming out there.
Yeah, that's great. So since you mentioned the IRA, that is hailed as landmark legislation for the investment in striving in domestic energy production while focusing on promoting clean energy. How has this law impacted your approach for investments in green energy production?
For us, in the earlier stage, I think it allows a lot more ideas and concepts to materialize because it's being funded by non-equity investments, right? So the pressure to perform is coming back off, and the pressure to explore, not even pressure, but just to fuel the desire to really evolve a industry and idea is there. And so it allows things to get much further along before they're coming to our doors. So we're looking at it and thinking, okay, we're not pre-seed, somebody can handle that. And if the government is doing that, there's a lot more exploration of ideas and concepts. And I think people feel a little freer to do that rather than taking that first check and having that first investor meeting.
Yeah, I think practically it's been less impactful than it has been in terms of sort of penetrating the zeitgeist of more generalist investors. So I think 2, 3, 4, 5 years ago, and Neil can probably back me up on this one, bringing generalist investors to the climate tech, clean tech party was pretty difficult. And that limited, the sort of supply of capital for a lot of businesses that were performing quite well, but, just didn't have the sort of enthusiasm within the broader investment community to raise capital in a way that was efficient. And now that's changed. I mean, every single generalist fund has a climate check or climate tech sub strategy now. And the proverbial phone is ringing off the hook for follow-on rounds.
Yeah, we've seen a lot of performance change, a lot of ambitious projects, right? That aren't necessarily software, hardware, but want to create new types of energies. Wave energy suddenly, is becoming, the performers are looking better. People are putting RINs and blenders tax credits and all this stuff on there, and which is great, but at the end of the day, you have to assess risk. And I agree. I think for long term, it might play out, but when you look at a life cycle of a VC fund, on average, 13, 14 years to vintage, right? You got to really consider what that impact does, right? Because even government regulations change and funding changes. Look at what happened to the tax credits for wind, right, in the United States and onshore development. So I think you just have to look at it through the right lens. But a lot of people are getting really excited, but you got to see past that sometimes.
Vaughn said it 100%. I agree with Vaughn 100%, and it's fascinating. And it was hard to, because there's Cleantech 1.0 wave or Cleantech 2.0, so it was hard to raise capital for our companies. And what's interesting is now suddenly these generalist investors saying, "Oh, okay, we'll come in and we'll look at it," and then they'll say, "Oh, we don't want to take a regulatory risk." So they'll then chalk IRA against regulatory risk, and they struggle to dance around what to do. And for companies, it's actually hard to quantify the benefit because it's huge. $370 billion is huge, and the biggest value there, a lot of companies are seeing that's different than other regulations where you can stack credits. So previously you get ITC or PTC, you got to choose one or the other. Yeah. Whereas here you can get LMI, low moderate income credit, plus the ITC. You can stack multiple credits. So the process is going to take longer. The number of people they're hiring to process through all this is taking longer. So almost all of our companies, I'm sure in your case, they have non-IRA projections and they have IRA projections.
Yep. That's great. And I mean, it sounds like general consensus is it's been very helpful, but not without limitation, right? So in that sense, what additional work could the government be doing to ensure investment in the broader clean tech industry, not just clean energy production, continues growing as well?
When you say broader clean energy, you're saying the entire sustainability, others, not just production.
Yes. Yeah.
Yeah, I mean, I think that the supply side needs to be addressed in a more direct and comprehensive manner. Demand is obviously key, and if you're creating a startup in the marketplace, a marketplace startup, then you're always usually focusing more on demand. But I think in our case, we have supply issues, right? We have supply chain issues. We don't have not only the vehicles that are in demand, but the proper incentives on the OEM side to create those vehicles. So I think if the policy was less focused on being demand driven and more incentivizing OEMs and suppliers, especially on the EV side, we'd be in a much better place.
Yeah, I think I'll use something really specific. I think that it comes down to data. I think that there are other countries, primarily in Asia, that are linking homes together through metered, startups. One example is Uplight out of Colorado, actually, that went public. And, they have, 40 million meters on there. If the government said, hey, I need this data to tackle these issues, I think we'd be better off, but they're not doing that like some of the other countries are around the world. And I think that's a misstep.
I would say, this goes with any policy, is generally consistency is very important. We saw that with PTC in the past, where wind PTC was only extended 2 years, and then 1 year they'll drop. So wind supply chain would go up for a couple of years, 1 year there'll be a big drop, and then they'll renew it, and then it'll go back up again. So consistency and long duration is very clear, is very important. And the second I would say is being very clear on who gets the credit, where the tax, who can claim what tax. Because right now, if there's a supply chain, every startup, every company that comes to ask for money claims they're going to get that money. Yeah. It's like the carbon offset. Everybody claims I keep the carbon credits. They're probably 10 times, that same carbon credit is sold 10 times in every startup. So I think having more clarity by the IRA coming out and saying who keeps what, who can get to this as quickly as possible will avoid noise and disappointments.
Interesting.
I would say education. Yeah. Because there's, Michael, I think you touched on, changes in political parties can change initiatives and bills and funds can get redirected, but the groundswell, how many more students are you seeing here? If you're educating at the youngest level, just awareness and consistency to Anil's point there, so that you get it from the bottom up. And that can stay, and it can actually have some longevity as an initiative for everybody.
Awesome. All right, so Michael, one of the areas of focus of Boundless Capital is sell-side mergers and acquisitions. Have you noticed any trends in M&A activity stemming from a slower rate of capital deployment now in comparison to last year?
Yes, slightly. I think that I'm going to answer that in a roundabout way. I think that what we're seeing is a saturation of startups that mature to the point where they're too big to get acquired, right? If you have a company that's valued at $200 million, how many acquirers do you have? Not a whole lot, because if I'm a company that's acquiring someone for $200 million, right, how much does it cost me to build that internally? So it's the mentality of built here, not built here. And what we're seeing is the strategics are slightly slowing down, especially in energy technology in general. I think they've been bolting on companies to fill goals and holes in revenues from previous acquisitions. So we're seeing definitely a slowdown in that. And I think everyone's waiting to see what the next big trend is. Obviously, with the government policies, that's going to change it. But people are thinking a little bit longer about acquisitions for sure, especially on the small side. So for a startup that has the performance says, 5 years we're going to exit 10x, of course, certainly, that's not happening. Valuations have dropped, as I think everybody here knows, significantly. Some of the subsectors I think that are doing well are certainly around, oil and gas technology. Well, look at what happened with oil and gas. It's doing great, right? Suddenly we got funds that are no longer ESG focused, endowments, they're, okay now. And, companies that have access to international markets, I think is a big one that people are looking for in terms of acquisitions.
Awesome, thank you. I was going to ask about the subsector, so I appreciate you touching on that. Opening it back up to everyone. So what are the strategics and acquirers looking for when pursuing an M&A? I'm assuming some of your portfolio companies might be looking at this path. So, are there gaps in their business model or tech or that they need to solve for? Is it geographic expansion, acquiring customers?
I'd say the number one thing they're looking for is growth, because they obviously see that this market is growing really fast, and whether it's inflation impacting them, because they needed to show points on the growth aspects to their shareholders. So in the last couple of years, they've been really looking for growth, and this sector, like for all the reasons we discussed, has huge growth potential. So number one is growth. The number two is business models, for sure, because the entrepreneurs are being very creative on. Think of any single model I've seen it change to a subscription model. For the right reason. Subscription models are valued higher there are legitimate reasons why they should be valued higher. And these entrepreneurs are being creative and pushing customers who are not used to, like utilities, not used to buying subscription models, and they're figuring out how to do it. So the large companies are able to get access to that. So I would say that business models is the second one, and technologies, obviously. So.
Yeah, I think what I've seen is definitely the business model. I think if you have a company that has a software subscription and they change their mind, and one's trying to make more revenue, you look at what value add you can provide. The reality is that the new business models, and primarily in climate tech and electrical vehicles, are not very defensible. You don't have a big moat around them. Dropping in chargers in the ground takes an electrical contractor and some permitting. It's really not that hard. It's hard to get the customers and figure out how to do it correctly and efficiently. So I think building a moat around businesses is really, really important, a focal point, and I'll second that. Customers. We're in the sell side, and we're looking at large strategic acquirer, and they didn't care about the tech. They wanted the client list, and the tech was bespoke, but it wasn't that.
Yeah, I think to Michael's point earlier, we're actually seeing sort of a shift down, whereas 3-4 years ago, strategics were acquiring startups. Now there are startups that have scaled to the point where they're acquiring like earlier stage startups, right? And that seems to be consistent across every subsector within the climate tech software world, whether it's a utility scale solar design company looking to acquire a software for siting, that very same sort of generation capability, but basically trying to vertically stack all elements of one of a subsector via sort of inorganic acquisitions. Definitely something that I'm seeing a lot of, and I think will end up catalyzing the next wave of those larger acquirers acquiring.
Yeah, to Vaughn's point, we're seeing some earlier stage companies looking at M&A for purchasing, for positioning and cross sell. And we're trying to pull them back, stay focused on what we're doing, but it does make sense. And strategically, it aligns. It's a quick way to really grow the companies.
And Tim and Juan, if I can ask, are those more stock mergers or are they what kind of?
Both.
It's hard to make those mergers.
So, we've seen it in our own portfolio on the cash side, just finding the right small, sort of small company that you can acquire for, call it 5-10 million, right? And, in many cases, these are bootstrapped companies in that case where, there's not a contentious board sort of decision. It's just a founder being like, yeah, I'll take some cash and some equity and roll in. And then with some of the larger companies, definitely stock transactions. That's from my perspective anyway.
And ours are smaller, and we're leaning the conversations towards cash. So we have one ownership group, one management team, as opposed to fighting over valuations and then positioning and getting through or addressing more than just the business. That's all we want to stay focused on. Our conversations don't last very long in that.
Yeah, I'm a big fan of that strategy of like consolidation at the early stage, and it's hard to do, but if companies are able to do it, it's a great way to grow.
Yeah, and I've been seeing a lot more earnouts in the back end. I think that's becoming more evident, right, based on milestones or bring over customers or product features and innovations. But yeah, definitely a little bit less cash and more earnouts in the back end, making it, appealing to people, especially when their startup hasn't done the J curve that everyone projects. So,
awesome. All right, shifting gears a little bit back to your firm-specific strategies. So there's no shortage of news around the amount of dry powder that VCs are currently sitting on. However, historically, economic downturns have also fostered some of the greatest innovations. So what strategies have your firms adopted to balance uncertainty in the economy and more hesitant LPs, while also ensuring you don't miss out on the next game-changing opportunity?
For us, we're very involved in the schools, the communities, the startup ecosystem, from pre-accelerators, accelerators, Techstars, whatever it is. And not reducing that because now we've got an increased need to go raise more capital, and just staying very consistent and diligent with our approach. We're the same firm that we were a year ago. That hasn't changed. And again, that emotional first, let's go try to grab some more LPs. This is important. No, consistency is important because that's how you can have consistent returns.
Awesome.
Yeah, I couldn't agree more with what Tim said. I mean, the way that we try and differentiate ourselves within the LP community is being extremely disciplined, extremely diligent, and extremely consistent. We do 4 to 5 deals a year, every year. We construct portfolios of 15 to 20 companies, fund after fund. The macro environment is, it's certainly, I'm not one of those venture guys that says it has no effect on the venture market. But I think it has, less effect on the venture market than many people either want to, either be led to believe or want to pontificate upon. So yeah, remaining consistent. I think the most important thing is shoring up and conveying and instilling that discipline among your portfolio company CEOs so that they're prepared to weather storms that may be unforeseen.
yeah, I think the number of VC funds over the last 5 years probably doubled in the United States alone, right? Easily, if not more. I think it's very hard for VCs to prove that they can find the deals, right? It comes down to deal flow, and when you're running a fund with 20 to 50 million, and you get your 2 and 20. It's really hard to have a large staff that you can afford to go out and find those deals. So I think, VCs playing together versus competing against each other is what I've seen. A lot of the VCs I deal with certainly are in that network where they said, hey, talk to my buddy here and so forth. So I think it's just consistency in finding good deals, which is really, really hard.
What I've seen is, timing macro shocks is almost impossible. Yeah. People can pretend looking back saying they can, and they pretend it. So the reason I agree with all three of them is the way you don't play that game is to be consistent. You just keep on doing what you do, and for entrepreneurs too. There's clear data. If you look at venture and private equity performance, the funds that were deployed during downturns are the best performing funds. So, but you don't know when that is. So, and you can't raise capital once you know there is a downturn. You can't go and quickly go raise capital. So you can't keep on doing what you're doing consistently. And for entrepreneurs, downturns are actually a great time to start companies, even though your valuations start lower.
Yeah.
When things turn around, you'll sell it at a much higher valuation. So, but it's easier to start companies when markets are higher because capital is chasing you. But then when a downturn hits, you have to take down rounds and all employees leave, and it's hard to turn that ship around.
Yeah, I mean, the macro corollary is just the reason that those funds outperform is because they're entering at lower prices, right?
Yeah.
So,
Absolutely. So yeah, like Neil, like you said, downturns are typically times where lots of companies are being started. What are some specific areas within the clean tech industry that you feel are well positioned for massive growth or to disrupt existing industries that may not be prioritizing sustainability or positive environmental outcomes?
I think payments. So, for instance, you think of electrical vehicle charger, right? It's got to process credit cards, right? So I'm thinking about very specific tie-ins to current infrastructure that can help. So software that makes it plug and play for for GM. I don't believe they want to build their own networks. They want to play with everybody. So who's the software vendor or innovator behind that? And I'm thinking of the really small components of that wheel. I think that they'll do well.
I'd say, there's hard to abate industries if you take it from carbon, like heavy manufacturing industries like aluminum, steel, and with lithium-ion batteries. It's so much onshoring, you got to start mining. So these are all shovels in the ground and big heavy metal. These are industries that you really need to decarbonize from a climate perspective. And you need a lot more capital. For a lot of the venture funds, that's not the right easy to play, but big funds like Breakthrough Energy and Lower Carbon, they are able to go after the big ideas. So on one end, I think that's a great place to play because there are going to be a lot of winners that go in after these hard to abate sectors. And on the other end, where you asked for advice for entrepreneurs, there are a lot of small layers, whether it's the data layer, the payments layer. There is efficiency all around us. How do you circular economy? How do you recycle electronics? How do you recycle waste? And how do you reuse stuff and to software? So I think there is a resource efficiency themes all around us that they're easier to start and easier to implement.
I think consumer goods delivery, right? We've gotten really good at focusing on the goods, and we've got B Corp companies, but then a product might get moved 16 times. And how many delivery vehicles do you see on your street? There's a gap there, and nobody's really addressing that. But somehow, with everybody's instant gratification, we need to solve that with a few less vehicles, a few less trips.
yeah, I think probably operations and maintenance across, or as everything becomes electrified. So whether that's predicting thermal events with batteries, but be they home or electric vehicles, the company Acure that we're invested in, or maintaining uptime for public charging infrastructure with the company that we're invested in called Charger Help, just maintaining and operating the electrification of everything and leveraging software to do that.
And then, of course, add AI to everything.
Yes.
I mean, I joke and don't because it is an important element of it all. So.
Obviously been a very relevant topic as of late.
Yeah.
So the uncertain macroeconomic environment has been mentioned a few times in this conversation. How should current clean tech entrepreneurs approach decisions around when to raise funds, how much to raise, and who might be the right investors for them during these times?
I think like any time, making sure you're aligned, it's the right stage, right thesis, start there with the group. But there is a silver lining to it that you're not really being judged on the flash and pizzazz and the billion-dollar exits. People are really diving in and due diligence to legitimacy of the business. Can this run? Can this team do this? Does it make sense? They're looking a bit more than the 10 pages that come across the desk, right? Because we are working hard to really dig those out. And so you're not put up against whatever might be the hottest, social trend or whatever big tailwind is there, and you're saying, "Hey, I'm here too." Now, people are looking at what everybody is doing in these different sectors.
Yeah, I think just qualify your investors and the folks that you're speaking with, and make sure that they're interested in the stage at which your company is currently operating, for the sake of your own time and for the sake of theirs as well. And then I think most importantly, if you're very early stage, try to understand the landscape of the company or of other companies that might be your competitors before you sort of dive in. And I'm just thinking of, there's a lot of home electrification heat pump startups right now. There's a lot of tax credit marketplace startups right now, and I think that not entering busy waters is an important part of success during times like these.
Yeah, I think, raising capital is akin to dating, right? The longer you know someone, right, the more you know about them. I think you never stop fundraising as a startup. I think you continue those communications. What I recommend people not do and not do is based on the economic environment, the tax credits and all this stuff, completely pivot your narrative or what you're doing, right? You're chasing the next shiny object. So I think conviction is really, really important. Long investor knows you that you have conviction around what you're doing. Sure, there's pivots are fine, right? But just maintaining the course. And of course, due diligence. A company with $10, $20 million in revenue startup, we have a data room of 200 documents. We have to substantiate your customer contracts. We have to make sure they're signed. You keep that up and do that, you're going to have a much better curve of getting into due diligence with an investor. I mean, it takes so long to put that together and scrub it. So yeah, just good housekeeping.
You guys have done a great job of putting this panel together because it's by stage, right? So Tim is a seed stage investor. Vaughn is like early to early growth investor. We're a growth stage investor, and Michael comes to help you raise capital or exit the companies. So knowing what stage you are and is very important to Vaughn's point, and it's important to start at the right place. If you get the right start, they'll help you navigate to the next stage. So because we're all helping the companies get to the next stage. So I think that's important.
Awesome. And I think I have one more question before we open it up to the audience for Q&A. So obviously we're here at Anderson, MBA students and undergrads as well. What advice do you have for students that are looking to break into the clean tech industry but may not have that directly relevant experience or are unsure of which vertical they want to focus on?
So the first step is showing up, right? And making relationships, because it is not necessarily about what your domain expertise is, because there's so many different parts of a business that are required, finance, marketing, operations. It's not necessarily that you have to know everything, have a PhD and understand it, but feeling really comfortable in your contributions, what you can add, aligning what you're passionate about to what you're good at, and making sure people know where you're going, not where you've been. When you say, I'm so-and-so, this is where I'm going, not what I've done, because you're going to typecast yourself to what you used to do. And if you're here, you're trying to evolve and go somewhere, I would assume, somewhere different. Yeah.
Yeah, I mean, I couldn't agree more with what Tim said. I mean, everybody that's here is bright and driven and, down to put in the elbow grease required to make great things happen. So put yourself in the right positions and expand your network to the point where, those opportunities arise. It's really all about meeting people and being available at the end of the day.
Yeah, elbow grease for sure. I'm probably the least smartest person in this a wonderful room of people at Anderson, but I can outwork just about anybody, that's for sure. And I think along with that, you have to understand how to add value. Everyone's like, well, how do you network? I have probably 4 or 5 people that have helped me build my career over the last 10 years. It's about knowing how to add value when they introduce you to someone, right? Don't take an introduction email and be like, oh, great, we'll chat sometime. Do something of value. Don't expect necessarily something back right away, right? It's good faith effort that will come back around tenfold.
I think great points. In addition to showing up, which is a fantastic point, I think make the ask. I think there's not enough talent in this community. Don't assume, oh, I don't have the background, because a lot of people don't have background in clean tech. So everyone is kind of trying to make the shift. It's not easy. I'm not saying just because you make the ask you're going to get, but internships are a way to get going. So you got to have that first experience somehow working, advising an entrepreneur in your free time. If they can't afford to pay you, just trying to say, okay, I'll just help make some introductions, add value. Then you get that experience going and then get into the industry.
And I'll add one more thing. You guys are in California. It's a great place to do this. And look at other states. In Colorado, we have something called the Colorado Clean Tech Industry Association. We have a job board on there. It's probably got 90 jobs. just in the state of Colorado alone. Look to other states for these opportunities, and don't hate on Texas because of oil and gas. Part of the transition, and I spent a lot of time there because that's just the world that is surrounding it. But Texas has got a lot of opportunities as well, right? So think about outside of just your geography for those opportunities.
Awesome. Thank you all for that. We'll open it up to the audience for some Q&A. I think John's going to run around with the mic. Yeah.
Hey guys, Ivan and Alon. You mentioned the generalists coming into the space. Earlier today, someone mentioned that valuations in climate tech haven't corrected as much as elsewhere, and also that in the high times, there's been a bunch of fundraising that companies need to grow into. So I'm curious, I see some head nodding. Some first question was, to what extent are you seeing this? And also, maybe, Anil, you've been at it, I guess a bunch of you guys have been at it for a while, but, to what extent, what do you see this doing to the landscape in the next, call it 2 to 5 years around, what happens to companies, what happens to funds? So are valuations, inflated because of that flow of capital, particularly generalists, and then, what do you think happens in terms of, how you deploy and I'm wondering about consolidation and things like that.
I'll take a stab at it, and you guys can correct or
Sure.
if you have a different view. But I think some of the generalists who are, some of them are visitors, so they'll come in because the sector was good. They might do well, they'll stay. If they don't do well, they'll retrench. So, which happened in Cleantech 1.0. A bunch of VCs, generalist VCs, all had climate, early stage climate practices, and all of them retrenched into 2012 after the global financial crisis when they didn't see Cleantech 1.0. Solyndra happened and they didn't want to do it, so they all left. So then things corrected by itself. This time I do think it's different because of all the factors I said. So, but too much, people are raising $5-10 billion funds, then there are not enough opportunities there. So consolidation of companies, they're trying to get companies to get to the stage that can take $500 million or $1 billion at a time to grow in. So I think some, in the next 2 to 3 years, valuations will adjust maybe this year, continue to come down. They have started coming down. From an investor perspective, it'll adjust. As long as companies are growing, those companies will continue to get higher valuations and good for them. And so market, but the reason for higher valuations because of more capital chasing them will go down, and then those funds will leave the space, and then it'll correct itself, is my view.
Yeah, I think there's a couple of contributing factors there. One is a lot of the growth stage capital came earlier after growth kind of blew up as a sub-asset class. That inflated early stage valuations. But I do think that the capital was attracted to sort of more of those like the breakthrough / lower carbon type of deals that tend to be a little bit flashier and tend to have a larger sort of, tons of CO2 abated impact, or an easier story to tell there. Whereas a lot of the sort of nuts and bolts, more operational businesses had lower valuations and continue to have lower valuations. But ultimately, the amount of dry powder and the amount of capital that's been raised and funneled by the LP community it'll probably correct itself as a result of, performance issues, right? At the end of the day, if people are overpaying for deals for 3 to 5 years, what that means is that their performance is going to drag, and then that capital won't be available. So we'll be here.
Any other thoughts?
I'll give you the entrepreneur's lens because that's more of an operator thing that I've done. I think looking at valuations is important when you're talking to investors. As understand, there's portfolio theory, right? If your investments aren't valued too much, right, your portfolio isn't structured correctly, and then the one success out of 20, kind of dumb math. Doesn't really work. So I think you have to understand that going to investor, you can't go and ask for pre-money of $60 million when you've got zero revenue. And also understand that a lot of the stuff in the private capital markets, you can't pull a Crunchbase report on climate tech and say, there was $1.2 billion invested when $800 million was one deal, right? And that's what people look at. So understand how to break down a sector using any data you can get your hands on, which is probably going to be slightly inaccurate, right? So yeah, think about what's important for investors. And at the end of the day, if you're a founder that is worried about 5% dilution in the cap table upon exit, and I got some bad news for you. It's not going to work out. You're fighting over 2%. What's that really work out to? I'd rather have 10 cents of something than $100 of nothing.
Yeah, and I'll support Vaughn. They're some of the smaller cap companies, not taking over the world. Their valuations haven't changed at all, and they're still fair. Like they're still very digestible.
Any other questions from the audience?
Yeah, I'll just try to be loud. So I appreciate the conversation about mergers and acquisitions, what's happening with their portfolio companies and potential bolt-ons or add-ons or some partnerships. My question is whether or not there's any interest in this portfolio to go into reverse takeover, an RTO type of opportunity where they may want to go into the capital markets. Maybe they can't find an acquisition in a $5 to $10 million space, but it's already public. They can get into the market without having to go through all of the transactions of doing an IPO. Any comments about that?
I mean, I think it's a really pointed question. I think I look at it as a geographical thing because I think different markets have different. The Toronto Stock Exchange, right? Not really hard to be public on there. Hong Kong's got really great stable currency. Doesn't take a lot to IPO there, and we have VCs that take companies over there. I think it just depends on a lot of the actual economic climate when it has to do with that. I mean, if you're, again, overpaying for a reverse merger to basically get contracts that don't have to get re-signed by the client, you have to understand if that's worth it, right? But I haven't seen too many of those, to be honest with you. Maybe not our world, but certainly not some that I've seen trending up anyway.
Where I've seen a couple with SPACs because their timeline is expiring and the companies went and reverse merged with a SPAC and saved them a little bit. But I don't know if there are enough of them to go a lot of volume because the companies, post being public, need to act like a public company, and there are not enough companies at that stage in the sector because it's still at that early stages. So you need to know, and when we are advising those companies, we're saying, hey, you need to be able to project quarter by quarter, like have very clear visibility, and a lot of these business models are still evolving and lumpy, and so I think if they're not ready for it, we're not advising them to do that. But there are reverse takeover opportunities in the SPAC right now, I think.
Yeah, I think, what people didn't realize, or the only people that really made out well during the SPAC boom were the lawyers and the bankers. It certainly wasn't the companies, and it certainly wasn't the equity holders, but there was a lot of splash. But at the end of the day, you're going to be held to the standard of Wall Street, and you're going to get crushed if you're not doing things correctly. So it's I don't think it's quite as enticing as it seemed.
All right. If there's no more questions from the audience, I have one last question before we wrap up. So why would you say now is the right time to be either a clean tech investor, entrepreneur, or operator?
I'll summarize it in one sentence. We're going to see the greatest transformation of wealth since post-World War II with the clean energy transition.
100% agree.
Yeah.
Love it. Short and sweet. What a way to end. Awesome. Well, thank you so much for our panelists today, everyone.